Hi guys, welcome back to my channel. Kelvin here. So it's finally here. The bear market has finally arrived. All the bears like Michael Burry, who were warning about a market crash 5 years ago, be like, le koala, le koala. Now, I'm pretty sure many of you guys' portfolio are either red or super red, especially if you have just started to invest 1 to 2 years ago. Welcome to the real stock market, where it's not just stonks every day. But as the saying goes, riches are made in recession. Things may seem bad now, but if you know how to invest during this period, you will come up much more ahead than everyone else when all this is over. So in this video, I will share 6 ways how you can take advantage of the market crash. But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so already. Let's get this channel to 100k by the end of this year. In return, I will show you 2 cute guinea pigs. Alright, let's start right now. First, buy the dip. This should be super easy. You keep buying and crying all the way down. There are 3 main strategies for buying the dip. First, you just close your eye, then look at the stock price and keep buying consistently. When you buy, it's totally up to you. Some people buy once a month, some buy once a week. It doesn't matter when you buy because there are many studies that found time in the market beats timing the market. But if you still want to time the market, there's a better way. You know how Warren Buffett always say, be fearful when others are greedy and be greedy when others are fearful? According to CNN's Fear and Greed Index, there's extreme fear now, which means it's time to be greedy. Okay, here's how to use this data. Right now, I'm on TradingView and this is the S&P 500 chart. I will change this to week because I will be able to see the bigger picture. Go to Indicators, type in Fear and Greed. Choose the first one, Fear and Greed Index, Bushy. Okay, the color is a bit hard to see, so I'll change it to orange. When the line goes too low, it means extreme fear, and if it goes too high, there's extreme greed. What you will notice is that if the line goes to around 10 to 15, the market will usually go back up. It happened in 2020, 2018, 2016, even during the 2008 Great Financial Crisis and 2000 dot-com bubble. But you can see that it may not be 100% accurate. Like here, you can see that there's extreme fear now, but the market only started going back up a few months later. What this tells us is that whenever there's extreme fear, it means it's a good time to buy. Like right now, the Fear and Greed Index is around 15. So it's time to buy the dip. Okay, let's say if you still want to time the market, let me tell you how to do that. Yes, you can wait for Chicken Genius Coco to tell you when he's buying. Or here's another way. You can use something called 200-week simple moving average. Basically, 200-week simple moving average just takes the average of the past 200 weeks. Here's the graph of the S&P 500. Take note that I'm using SPX here, yeah? Again, I'll change it to week to see the bigger picture. Then I'll go to Indicators, search for 200-week simple moving average. What you will notice is that this SMA has a very strong support and resistance level. In 2020, when it broke past the SMA, it quickly came back up. Prior to that, whenever it comes near the SMA, it usually bounces back up. In 2008, the market crashed and went past the SMA, but again went back up after that. Same for the 2000 crash. Crashed past the SMA for a while, then went back up. Prior to 2000, it has always bounced off the 200-week SMA. So if you fast forward to today, you can see that if S&P 500 were to fall towards the SMA, it will be around 3,510. Which means that if you really want to time the market, you can buy around this price. Also, using Tesla as example, before the crazy WTF run-ups, Tesla has always been trading around the SMA. Right now, if Tesla were to fall towards the SMA, Tesla will have to fall to 402, which I think is totally possible if things were to get worse. But again, maybe it won't. Tesla can just turn around and reach 100k by tomorrow. You never know. So only use this method if you're okay with missing the boat if the stock suddenly shoots back up, because this is considered timing the market. Quick pause, just in case you haven't heard, Webull is the latest stockbroker in Singapore. With Webull, you can buy your US stocks, US options and Hong Kong stocks for a low fee of $0. Yes, you heard that right. There's $0. They also have fractional shares, which lets you buy your stocks with just $5 angpao money. Then, of course, you might be wondering, what's their welcome gift? I'm glad you asked. If you sign up with my link down below, deposit at least $2,000, then make 6 buy trades on either US stocks, ETFs, or options, you'll get $100 worth of Apple shares. This promotion ends on 30th June, yeah? With that being said, let's get back to the video. So, you know how some people be like, market going down? Short the market to profit lor. That's actually a bad idea, because if you are wrong and the stock suddenly goes back up to the moon, your loss is unlimited. That's what happened to Melvin Capital, the hedge fund that tried to short GameStop and lost billions of dollars when Wall Street bets pumped the stock back up. Second, if you are shorting the stock, you need a lot of collateral, typically around 150% of the value when you initiate the position. If the stock goes up, you can be margin called. So a better way is to use inverse ETFs. Basically, inverse ETFs is exactly what you think. If the stock goes down, the inverse ETF will go up. There are tons of inverse ETFs out there, like ProShares short S&P 500, which has already given 23% return year to date, or ProShares short QQ, which gave 37% return this year. Or let's say if you are bearish about ARK ETF, you have SARK, Total Capital Short Innovation ETF. And I'm sure that Tesla Best will like the -1x short Tesla ETP, which already gave 47% return year to date. However, with that being said, there are a few downsides to this strategy. First, you'll be using valuable money to make this bet, and you will end up having less money to buy the dip. Second downside, market is unpredictable in the short term. It can go down or it can go up. Nobody knows. If you are wrong about the direction, you will lose money. Over the long term, the market will go up, so you are sort of betting against the market. But if you are confident that the market will fall, this can actually be a good short-term play. Okay, so just now are all just the basic methods. Anyone can do it. Even your Sergeant's Armor can do it also. But here's a slightly more complicated method. Cash covered put. If you blur and don't know what that is, basically you are selling a put option, and 1, you earn money, and 2, you have to buy 100 stocks if the stock drops below your option strike price. Let me show you what I mean. This is Tesla stock. Right now, Tesla is at $662, and we are looking at options that expire on July 15. Let's say I sell a put at 405 strike. By selling this put, I will get paid $440 immediately. Then I can do whatever I want with that money, because that money is now my precious. Two things can happen. By July 15, if Tesla stays above $405, nothing will happen. But if it goes below $405, I will have to buy 100 Tesla stocks at $405. Okay, yeah? So just now I said that you can time the market by using 200-week SMA. For that method, you can time the market by placing a limit order at $405. But now, if you have the money to buy 100 Tesla stocks, you can actually sell cash cover put at $405 and get paid while you time the market. Personally, I'm using this strategy, but my purpose is not to buy 100 stocks at one go. It's only to earn money. On average, I'm earning around $500 every time I do this. And if I do this long enough, my Tesla cost basis will go down over time. Just take note, this strategy is also what people call picking pennies in front of a steamroller. This is not free money, because in order to earn like $440, you better make sure that you have 40k lying around, just in case Tesla crashes and you have to buy the stock, yeah? Fifth strategy, covered call. Now, this is totally the opposite of the previous strategy. Instead of selling put, now I'm selling call. And if the stock goes past my strike price, I will have to sell 100 stocks. Again, let's look at an example. Let's say I sell a call at $880. I will get paid $560. On expiry, if Tesla stays below $880, nothing will happen. But if the stock goes past $880, I will have to sell 100 Tesla stocks. If you believe that the market will go down, this method is actually quite good, because you are sure of the general direction of the market. Like I know in the short term, Tesla will most likely stay around $600 or go down. And there's very little chance that it will go back up to $800. In that case, I can sell a call at $800. But in the event that I'm wrong, I can just let my Tesla stock get called away or roll my options upwards to avoid getting called away. Rolling just means close the current option at a loss, then sell a new option at a higher price to cover the loss. Prior to this crash, I'm selling calls as far as I can to avoid the stock getting called away. So I'm only earning around $400 per call. But now, since I'm more certain that the stock is likely to go down, I can sell the call nearer and collect more money. So right now, I'm earning around 1,000 plus per option. Again, take note that you need to have 100 stocks when you do covered call. Otherwise, it's a naked call, which is bad because if the stock shows up, the broker will margin call you. Next, you know how people always say you can buy a put to hedge against your downside? Well, yes and no. Buying put is actually a good hedge because if the stock goes down, the put will go up and it will cover your losses. But if you are wrong about the direction, if the stock goes up, the put will become worthless and you will lose a lot of money. So here's a better way, collar strategy. This is the method that Chicken Genius Coco is using to protect his downside. He calls it synthetic short, but it's actually a collar strategy where you combine stock plus long put plus short call. Here, he verified this is what he's doing. Okay, I will explain this strategy using an example. Let's go all the way to January 2023. First, I sell a call at $670. Then, with this money, I can buy a put at $670. Two things can happen here. First, if you are wrong about the direction, meaning the stock go up, your upside will be limited because you have to sell the stock at the call strike price. In this case, at $670. Or second, if you are right, the stock goes down, your downside is protected by the put. Essentially, you have hedged your downside. Personally, I feel this strategy is quite good if you are very sure that the market will go down because you don't have to fork out extra money to buy the puts and you will protect yourself if the market goes down. Anyway, those are the 6 methods on how to take advantage of the market crash. Hopefully, this helps you out. But what other ways do you know of? Let me know down below. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.